Hello, folks. So far, we have dealt with the historical origins of the Latin American economies. We also went in detail with the Latin American macroeconomics. And in the last two sessions, we went through structural transformation, institutions, and economic growth in the region. Now, we're going to give a look to Latin America from the global standpoint. That is to say, how has evolved the global context in which Latin American social and economic development has taken place in the recent decades. And given the novelty, the historical transformations coming with the ascent of China, we will dedicate some time as well to at least approaching minimally what does the China's growth and rebalancing mean for the region. Let me start with what I call the shifting tectonic plates in the global economy, which with such a shift happening, particularly in the 90s and at high speed in the 2000s, in the first decade of the new millennium. To some extent, those shifts have had some accommodation after the global financial crisis of 2008, 2009, but it's still, as we will discuss, some of the changes brought in by the shifting tectonic plates are still valid and quite important for us. Let me summarize why I call the dramatic changes in the global economy in those 2 decades as shifting tectonic plates. By that, I mean 3 major shocks taking place in the global economy as reflected in the ensuing, in consequence, changes in 3 basic prices: labor, capital, and natural resource. Look, first, the supply shock. Why one can indeed call it a supply shock. In a reasonably short space of short time span, the labor supply operating in the marks of the global market economy increased by something close to 1 billion people. That's a lot. And with a consequent reduction in the price of labor, if one takes into account, let's say, wage aspirations and the possibility of integration into the global market economy. Of course, I have in mind what happened after the Berlin Wall, the dissolution of the Soviet Union, and the incorporation, the potential incorporation of a supply of labor with, in most cases, good levels of basic education, right? But also I have in mind, obviously, what happened in China when suddenly, after Deng Xiaoping's reforms, a substantial number of workers was made available to be integrated into the global market economy, starting with the special economic zones established by Deng Xiaoping, surrounding cities like Shanghai, surrounding Hong Kong, but also special zones mired at places in the neighborhood, regional neighborhood, where there was and there is a substantial Chinese diaspora. There was an area looking at Taiwan, China. There was an area looking at Korea, an area looking at Japan, Singapore, and so on. But then this process, as it succeeded, was extended to a larger part of China. Well, the point is that this incorporation of labor, low-skilled labor particularly, but with wage aspirations, for instance, lower than the ones of the previous southern countries, for instance, in the region, in Latin America, made a significant change at the world level downward of the price of labor. This was made possible by the incorporation by particularly, or was more than possible. This was boosted by two simultaneous changes taking place. One of them, a clear tendency of opening trade in most countries. In a short time span, historically speaking, tariffs were decreased. You had the reduction of non-tariff trade barriers. There was a will to integrate, commercially speaking, like in the special economic zones of China, where even a wild type of capitalism was allowed to flourish with no labor market regulations, with no intensive tax system in place, without having everything that we associate with, let's say, modern capitalism. It was really wild capitalism taking place in the soil of the communist part-led country. And as well in Eastern Europe, you no longer had the kind of restrictions that characterized the Soviet Union style of policy making. But also, quite important, simultaneously, very important technological breakthroughs that made possible that incorporation of labor, which is the so-called fragmentation of production processes that ended up making possible the expansion of the global value chains. What are the global value chains? They are following. You have a production process that tended to be in the past, let's say, implemented, tended to operate as a single unit with some proximity of the components, of the production of components, and so on. And then suddenly the technological breakthroughs, particularly not only in information and communication technologies, but also in transportation. That's when we have the containerization with a dramatic cost reduction in transportation, made it possible to fragment the production processes, the manufacturing production processes, into different states and locate those states wherever it was convenient from a perspective of cost. And that therefore made possible the extension and the delocation of labor-intensive segments of production processes, but including low-skill segments of the production processes to places where labor was cheap. And we had a rehearsal, or we had the first development of such value chains in the previous decade. I wrote a book on this, comparing Brazil and South Korea, and how South Korea went through the ladder by exactly being incorporated as part of the value chains. At the time, it was called regional core networks of production. And then the expression became the value chains, global or regional, where in the case of Korea, they benefit in the beginning of the transfer of labor-intensive segments coming from Japan. And then they made the effort to go up the ladder. That's a full other story. But the point to make is that the combination of technological transformation, making possible the incorporation of a large swaths of this population in countries where you had now labor available to be integrated, and together with public policies, facilitating that possible, that process generated this price of labor shock, which has been definitely one of the factors helping the inflation rates in the global economy to remain as low as they are. Not the only one, but definitely quite important. But also we had a financial shock associated to which one may refer to a declining price of capital, of money, of resource for investment. This has to do with the dynamics increasingly assumed in advanced economies as increasingly asset-driven. I know this is no time, we don't have the space here to go through this, but I can tell you that the low interest rates that we watch nowadays, and this has been a trend going on for the last decades, and they have to do with several hypotheses. If any of you has any specific interest on the subject, there are 3 chapters of my book, the book that I distributed, dealing with that. But the point to make is that one has clearly seen a downward trend of long-term real interest rates in the advanced economies, while also one has watched financial globalization and the increase in the volumes of capital flows to the southern countries. Through successive cycles of booms and busts, we had the first. We discussed the time of the petrodollars in the 70s and so on, but I have in mind here more the market-based source of finance that started to flow to emerging markets and some low-income countries in the 90s, and we had the emerging market crisis in Asia in 97 and in Russia in 98, and in some places in South America we had a crisis. Well, we had also in Mexico and so on. But the point to make is that along those cycles, clearly the costs of capital went down. Now, the combination of lower prices of capital and labor and the associated increase of production, and we will see the figures on GDP and trade, particularly in Asia, led to a third shock that is to say a change in the composition of global demand, with the demand for commodities regaining strength for the reasons we discussed in previous sessions about the higher intensity of consumption of commodities at lower levels of income because of the composition of consumption and so on, and the role and the weight of construction and investment and so on. And then the phenomenon of rising production in GDP in the southern part of the world, particularly China, led to a tremendous boost on the demand for commodities, in which was exactly not by odd reasons, by a super cycle of commodity price. Of course, as you can see, I'm referring to these 3 shocks because although understandable from a perspective outside the region, they kind of brought a strong influence on the events in the region. To some extent, of course, particularly the increase of the manufacturing, the global value chains to Asia and so on, created a huge challenge for manufacturing in the region. Even if in our previous session, we discussed the report of the World Bank, that did not attribute, quantitatively speaking, a significant weight to this when it comes to the premature deindustrialization of the region. Fact of the matter is that this has conditioned the prospects of rising manufacturing in the region. Mexico found a specific way through the integration in the northern part of Mexico, the maquilas and so on. But the nature of those shocks kind of compressing Latin America in some sectors while opening the space and opportunities in the case of natural resource is something that can be taken for granted. Okay, so these 3 shocks with corresponding price changes went through, as I said, some accommodation after the global financial crisis. China started its rebalancing process, moving gradually, very gradually from the previous model. We also, as we will see, watch some stabilization in the levels of financial globalization, although with very important change in composition. And we saw the end of the super boom of commodity price. Look at the rise of the South as approached in the World Bank report that I have been mentioning as a result of the shocks that I mentioned. Look, it was good time overall for the South. We will see. You will understand why I'm saying this. But look at this. These are the shares of the South in general. China is taken apart here. So, and this is the North. Of course, the sum is 100%. These are shares on both world GDP and world trade. It's fantastic. Look at the increase in the share of the South, including China, in GDP and in trade, exactly during the period that I'm referring to as the period of shocks. Just to remind ourselves of some of the figures. Some South countries have become major, systemically important players in the global economy. The GDP of the South, which represented about 20% of world GDP between the early 70s and the late 90s, as you can see in the chart, doubled to about 40% by 2012, with China alone accounting for 12% of global GDP, as you can see on the left side. And in the 2000s, this process was intensified. In the case of global trade, the participation of the South rose from 24% in 1970 to 35% in 2000 and 51% in 2012, as you can see on the right side. And also, let me call your attention to the sectoral composition in this change, which is quite relevant because this advance, the advance on the world trade share by the South, was accompanied by major transformations in the structure of the world trade, because the weight of the South varied across sectors. The left side shows how the South's share of global exports of manufacturers, reflecting the global value chains, as I said, increased from 32% to 48%, while at the same time, its share of global imports of primary goods, agricultural and mineral goods, rose from 32% to 47%. And by the way, at the same time, an acceleration of financial globalization accompanied the rise of the South in commercial flows, not only because of the trade finance, but also because of FDI, foreign direct investments, and other forms of financial integration of the South. Just to give an idea, the share of the South of global capital flows, including the foreign direct investment, rose from something about 18% in the 70s to 25% in the 90s, and to more than 50% by 2012. That's what the figure, if I had included here, would show. But you have it in the World Bank report. Of course, we have to highlight here, not to raise any doubts, that this was very heterogeneous in terms of regions. Latin America and the Caribbean remained with a weak participation in global value chains. And this is also to remark that the shocks that I'm referring to, they had differential employment effects in the South. And it didn't help in terms of growth, in terms of accumulation of assets. The fact that Latin America and the Caribbean exhibit in general low saving rates and low ratios of investment to GDP, as we have discussed before. And of course, all this brings implications for growth. But let me move on. As I said, we had some accommodation of those trends after the global financial crisis. That's why I brought those figures about the world merchandise trade volume. And as you can see in the chart, see the speed of increase of trade vis-a-vis the world GDP. The trade elasticity of the world GDP went up for a long time. Then it stabilized after this is the impact of the global financial crisis and the recession that followed. But the growth of trade afterward never took the dynamism of before, right? There are several reasons here. This has to do with China's rebalancing. If you want to know more about this, one chapter of my book, chapter 12, if I'm not mistaken, is dedicated to that, to the hypothesis behind the peak trade, as it's called. Of course, this is here reflecting the coronavirus, which we will discuss in our next session. But let me show a bit about what I meant about the financial shock. Again, we don't have the space, is not the time to go deeply on what has happened with the macroeconomic dynamics of advanced economies. But the idea of they becoming asset-driven, quietly dependent on the dynamics of the financial markets, with corresponding bubbles and busts and bubble blowing and bubble bust, manifests itself in this average behavior. Look at the evolution of private non-financial debt ratios in all major countries. And it's on purpose that I cherry-picked charts to show you how broad and generic is this trend. Japan went through this quite before, but also you can see that what you watch in the United States, to some extent also is present in the Eurozone, and also here in Canada, Korea, China for different reasons, and Australia, okay? And this, of course, would only happen in tandem with the downward trend in real interest rates, long-term interest rates. And that's why you have, this is the picture seen from another angle. For the US, look at how it's the era of big balance sheets, as David Levy from the Jeremy Levy Institute has named them. A trend towards rising debt. Of course, this reflects the effects of the global financial crisis, but I'm pretty sure when this chart was made in 2019, I'm pretty sure that we're going to see either some stability or a slight uptick after the global coronavirus crisis. And not only that, but now the interest rates, they reach their peaks and their troughs exactly increasingly at lower levels. So on average, interest rates have fallen in the dynamics. And this has expressed itself in, as I said, in the spillover regarding the global economy. That's why one speaks about financial globalization. By financial globalization here, I mean is the ratio of the stock of foreign assets to world GDP. And this chart shows the strong rising tide starting in the 90s, which seems to have reached the plateau since the global financial crisis, as I said. So the ratios right prior to the global financial crisis seem to have been a peak, like we saw in the case of trade. But keep note that, first of all, this apparent stability has taken place with a deep reshaping of cross-border financial flows. As you can see in the chart, there has been deep banking and an increasing weight of non-banking financial cross-border transactions. And obviously, the sources of potential instability and long-term funding challenge have morphed accordingly. But the point to make here is how we are in a different world from where we were prior to this spirit of global financial globalization. As compared to before the tectonic plates shift. And let me also illustrate the impacts of the triple shock. Looking at the super commodity price cycle, look at how they all went up exactly in the period that I'm referring to, the period in which that's the expression of the rising price of natural resource through the price of commodities. If you have any doubt, okay, this is 2008, but since then, of course, we had, I decided to add this chart showing the evolution recently. This is the period of coronavirus crisis, of course, and with but as you can see, the prices of other commodities, non-energy commodities, did not fall that much. And in fact, even the oil, which went down the hill by last year, of course, the coronavirus, even before we approached the coronavirus, basically led to restrictions to mobility, and that obviously led to a halt in the demand for fuels and so on. But it's on the way of recovering some levels. But it's true that we are not back exactly to the times of super price of all commodities. But note that they have not returned basically to the low levels of the past. So to repeat, after the tectonic plates, we are not anymore in Kansas. Now, just to repeat what I said, those 2 decades during the were overall very good overall for the South, for the emerging markets and developing economies. Of course, we'll say, well, with dangers, with perils, with traps, because Latin America and the Caribbean became even more attracted or addicted to high commodity prices. It's true, with all the challenges that we have already discussed. But while it lasts, the growth performance of the region was superb. And in many parts of the region, the opportunity was taken to boost mechanisms of income transfer. That's Brazil and many other countries in the region boost their foreign exchange reserves, which makes a huge difference nowadays. Brazil faces the fiscal difficulties, the difficulty to restart growth, but differently from the past, there are not any major concerns with the balance of payments, and that's due to the foreign exchange reserves accumulated both through the good terms of commodity price, but also through the capital inflows during the period. So the 2 decades were really good. To the point is, as you can see here, look, these are the growth rates, and see how the emerging market and developing economies as a whole exhibited rates of GDP growth very much above the ones of the advanced economies. And of course, this was the impact of the global financial crisis, but the recovery of the South was reasonably fast, and the average growth rate remains a bit above the advanced economies. Of course, there is a huge heterogeneity here, as we will be able to approach more in detail when we in our next session about the global pandemic and so on. But just to give an idea, the enthusiasm was so much here that in 2010, this guy here co-edited a book with a colleague, Marcelo Giugali, The Day After Tomorrow, where it was a very upbeat book about the possibility not only of convergence of income, per capita income, but even, as I alluded in one of the chapters written by me, the possibility of a switchover of global locomotives. After this book, I published 5 more, but it still was not high when I go in place. People ask me about the hypothesis that I alluded to in this book. And I myself wrote several pieces afterwards, not long after, to explain why maybe the enthusiasm was too much. But the reality is in the figures, as you can see, about the implications of the shocks that I mentioned. Well, and this comes out in the reduction of poverty. Look, those decades were pretty good when it comes to reduction of poverty at the global level in all regions, East Asia and Pacific, of course, but also South Asia in red, Sub-Saharan Africa, and in Latin America, in Caribbean, Eastern Europe, and Middle East and North Africa. So it was good for poverty reduction. And it still remained like that in the more recent years. Now, okay, so let me then approach China because, yes, before that, let me say something. One of the reasons for the overenthusiasm of the day after tomorrow of my book was that we did not realize, I myself did not realize, how key, how important had been the growth with a structural transformation in China. And as China was obliged to change, to alter its pattern of growth, and this has implied lower growth rates, how much that influenced the rest of the evolution of the South. And why is that? What happened? Look, China's GDP growth in 2019, the chart doesn't have it yet. Let's take out the pandemic, but even so, the performance of China in the pandemic has been, we will see in the next session, better than any other major economy. But the fact of them, it's an exceptional year. But in terms of trend, the growth of the China's GDP in 2019, something close to 6%, was the lowest in the past 2 decades. As you can see in the chart, there has been at play a slowdown in terms of growth rates, annual growth rates for China. To some extent, because the signals of a relative exhaustion of its previous model were clear by the beginning of the decade. Let me tell you a story, as I like to do here in our discussions. Back in 2011, I was at the time one of the vice presidents at the World Bank, and my boss, Bob Zelig, sent me to an important meeting in China to represent the World Bank, which was the meeting to celebrate the 10-year anniversary of China's access to the WTO. And the meeting took place at the Hall of People in Beijing. And my institutional address to then President Hu Jintao conveyed some of the thinking that was to be fully displayed in 2013 in a joint report by the World Bank and the Development Research Center of the State Council of China. And what we said there was that I conveyed the message about the exhaustion of the fantastic results of the previous model of China, because after all, look at the growth rates of China, double-digit growth rates for a long time span in the previous decades, which took China from the very low income status to upper middle income country already by 2010 when I was there. But what we conveyed then was that the factors behind such a stupendous growth could not be expected to remain ad infinitum. that the model would have to change in many respects. And guess what? And President Hu Jintao said we were right. And that's when I heard, personally, for the first time, the use of the expression rebalancing. China needs rebalancing. And by rebalancing, and President Hu Jintao in his speech mentioned the need to increase service and consumption, because the previous stupendous performance of China reflected a GDP composition where investment to GDP was close to 50%, 50%. Nothing ever had been seen like that. And that obviously meant a compression of shares of consumption. And it was only feasible by having somebody buying the goods and service produced by the structure increased via investment. And that was, of course, the current account surpluses, the trade surpluses of China. So it was clear that that could not rest forever. And at some moment, China would have to shift towards higher reliance on domestic consumption, which would imply lower growth rates, but at a very higher level than in the beginning. And also, higher domestic consumption would be associated with a feeling, with a perception of rising purchasing power of the population, which would be also a degree of satisfaction. And but also, China would need to move to upgrade to higher value-added industries, to go up the ladder and progressively shift its labor-intensive production to lower-cost locations in Asia and Africa, Vietnam, Cambodia, in places in Africa like Ethiopia, receiving ladder-related production from China. This was in the cards. And also, President Hu Jintao alluded to a rebalancing between state-owned enterprise and the private sector, so as to open space to the private sector growth and competition in those areas where the private sector could do it. This is the component of China's rebalancing that maybe has not advanced much. On the contrary, during his successor mandate, Hu Jintao, but still it is there as a possibility. Let me illustrate what I'm saying with the following charts, because I believe they tell us the whole story. And by the way, I'm taking these charts from one of the texts in the bibliography, which is my text on China's rebalancing. But look at when I mention the need. First of all, look at the investment to GDP ratio, which reached almost 50% in its peak, and it has been declining, as well as the current account surpluses, which have declined here. And this has been accompanied exactly by what I was saying, although industry, of course, had an upstake. The idea is to have increasingly an economy, a Chinese economy, more reliant, including on service vis-a-vis the industry. Even China is going through that. But let me, of course, it's easier said than done, because the starting point for China is one of a very unbalanced economy. So the transition toward less investment and less export-dependent growth model had to take as a starting point a situation of very low consumption to GDP ratios. Look at the left side of this chart. Look, on purpose, China here is taken apart. 2011, 2016, as you can see, the gross fixed capital formation as a share of GDP declines, but it comes from very high levels. Compare this to the position in other countries in the world, and this has a bit to do with the absence let's say, as I said at the very beginning, welfare state-like institutions in China. China is a combination of, in many respects, still a very state-run economy, with the state presence in the production in many sectors and so on, while the dynamic part, the booming part of China, has been the private sector production under very, very, very liberal, neoliberal. No, not neoliberal, because there was never a liberal before, but very much wild style, wild-like. But the figures, just let me give you an idea. No, instead of that, yeah, look, 2017, right? The private consumption was reasonably something close to 39% of GDP. You know what is the ratio in the rest of the world? 60%. So there's a way to go to in that direction. And as also you can see, the profit to wage ratios in the Chinese economy are very high. And you have, as you can see on the right side of the chart, low levels of public social spending. And this obviously leads to higher household savings. Of course, if you don't have the guarantee of access to the items of public social spending, right? You have to raise your savings, personal savings, to be able to retire. Particularly as now you have a smaller number of kids per family. So either you save or you are doomed when you are. That is to say, that's why there is this recommendation always comes from multilateral institutions and from many others, that in order to get there, to increase the weight of domestic consumption of goods and service, particularly higher value added goods and service, China would benefit from having, let's say, the development, the creation of a social public spending on social service. Paradoxical. Definitely compare with Brazil and the generosity of pension systems for part of the population, and you don't have anything like this in China. And but at one point, just to complete the rebalancing, this has been a very gradual process, in the sense that, like everybody else, China was feared that the slump after the global financial crisis might become an abyss for everyone, and everywhere in the world, whoever could implemented counter-cyclical fiscal policies. And the Chinese way of doing it was by looking the other way, while the shadow banking system, unofficial banking system, raised funds to finance investments in infrastructure and housing at the level, at the subnational level. And that, that smoothed the transition towards lower investment ratios to GDP. But on the other hand, it also smoothed the transition from the two-digit growth rates to lower growth rates, such as the 6% of 2019. But this left a legacy of debt, because obviously the indebtedness and the maintenance of high investment ratios was accompanied by a lot of shady investments, many white elephants in terms of housing and so on, the ghost towns that some observers remarked to, left therefore a legacy in terms of liabilities, but which has been reasonably contained by the authorities, and gradually this hyper leverage in the financial system has been dealt with moments of attention, as we had when China in 2015 moved toward liberalizing a bit the part of the capital flows, and that led to an outflow of capital from China, money coming out from the government of China, from the central bank to private Chinese going out, and so on. That became a wave on other emerging markets in Latin America, for instance. But one way, well, you will find the reference in my book on several things that I wrote about this. But the fact of the matter is that no financial crisis, no collapse has taken place, and they're moving gradually. Now, so there has been no financial disruption, although some analysts have predicted all the time kinds of crisis and so on. But one way or another, the fact that the Chinese government has fiscal space and has foreign reserves, it is able to implement official bailouts that may be needed. Okay. Now, which leads me to the last part of our discussion here. I bet I relate to you a video on the Chinese increasing interest on Latin America, starting from 2005, particularly. And this, but the documentary, the PBS documentary that I passed to you, it referred to the fears, particularly here in the U.S., about the presence of China, competing for influence, is the title of the program. And by the way, my book has an item on chapter 3 dedicated to that, to Chinese investments in Latin America, and regarding which I called it. I also wrote for this on to America's Quarterly on the metamorphosis of the Chinese capital flows to the region, moving out from state-owned the official banks, the China Development Bank and the Exim Bank, towards increasingly, and I hope that would be, when I wrote those pieces, it was more here to those years, a shift in the composition with increasingly less official finance from the state or to state-owned companies associated with commodities, as it was the case of Venezuela, the oil of Venezuela, the oil in Ecuador. They came for oil in Brazil, or to copper or other minerals and metals in Peru and so on. But now we saw a new cycle, a new wave of incoming capital, no longer from official banks, and more from companies, some of them state-run companies, some others private-run companies, towards service, towards management of ports, towards management of energy transmission, as they did in Brazil, more towards infrastructure service, and some to maybe to fintech, to finance, reflecting to some extent the rebalancing of China, and also the end of the super cycle of a commodity price. But unfortunately, things have also happened, as you can see in this chart that I took from the most recent report done by our Margaret Myers from the American Dialogue, which is a superb periodic accompaniment of Chinese finance to lack. In fact, we have seen, well, take 2020 out. This is, for obvious reasons, a special year. But there is, the fears about overflow of capital from China to the region are not to be, let's say, overstated in terms of size and so on. An important aspect here will be how will countries choose whether they will choose side in the confrontation between the US and China around 5G, Huawei, and so on. This is an unfolding story. But obviously, this chart expresses the flows of Chinese finance. But obviously, on the trade side, China has become the major partner, the major market for particularly the countries in South America. That's the number one for Brazil, number one for Chile, number one for Peru, number one for Argentina. And so whatever happens in China matters for the rest of, not only for the rest of the world now, but particularly for the region, given the integration through commodities, okay? So as you can see, in a nutshell, the triple shock that happened in the 2 decades or 15 years, so 95 to 2010, have remained. They have not been unfazed. They have stabilized or taken some directions, and they have definitely changed the parameters, the global parameters, where Latin America and the Caribbean is to develop. Thank you.